Every game has a set of principles, rules that you need to follow in order to be successful. I think investing is no different. In this video, I want to explain what I think are the rules you need to follow in order to find success with investing. My hope is that these 6 rules will give you a framework for making sense of the massive amounts of information out there. Because even with the endless amounts of articles, books, opinions, videos, and info out there that talk about investing, over the years, I've noticed that buried inside that information, there's actually a timeless set of rules and ways of thinking that all successful investors live by. So without further ado, here we go. The first investing rule to live by is to start before you're ready. You know what is the #1 killer of all dreams? That's analysis paralysis. Never getting started. And I actually have firsthand experience in this because I tend to be very analytical. I read a lot of things, I take in a lot of information, and I like to know everything before I take any action. Now, this is helpful and of course very necessary, but at some point, too much information becomes paralyzing. You don't want to make the wrong move, so you do nothing. Sound familiar? Maybe it's just the Asian in me that always wanted to get straight A's and win my piano competitions, but I find it very hard to take action on things unless I think I know everything that's gonna happen and I know it's gonna be perfect. You would think that one day you'll magically feel ready, but that's never gonna happen. I mean, this is with anything, even scary stuff like when I was starting my YouTube channel or just starting anything new. The secret, and it's not even really a secret, is to just start before you're ready because that's when the learning really begins. And until then, everything is just theoretical. I wanna tell you a quick story. I don't think I've ever shared this before, but back when I was working on Wall Street, I used to be a foreign exchange trader at a major global investment bank. And I'll never forget, there was this one pivotal moment. It was just a typical morning, just like any other morning, busy trading floor. And all of a sudden, one of the salespeople shouts from across the floor, "I need a quote for $100 million of Mexican peso for PIMCO." So PIMCO is one of the bank's largest clients. They're a hedge fund, and $100 million of Mexican peso is a huge trade. And immediately I knew, because I was still very junior at the time, that one of the other more senior traders on my team could do it. But there was this split second when I knew that this was my chance. I was still a very junior trader and I'd already put in my time, like done my dues, like getting lunch and coffee for everyone and asking all the questions and doing all the grunt work and just learning all the ropes, like staying after hours. So I knew I was ready for more responsibility, but I knew in that moment that the only way forward was by just doing it. I did not feel ready. Nobody was gonna give me permission either, but I stood up and just shouted back a price and the client traded with me. And it was really freaking scary. I mean, I can still recall like how much my heart was pounding as I was trying to hedge this position, this massive $100 million position in a very volatile currency. Because in case you didn't know, it's a very volatile currency, like a very wild one to trade. And the whole time I was scared and I didn't feel ready. But you know what? That was the moment everything changed for me. Not just for my career, because I became the head trader of the Mexican peso soon after, which was a big job, one that juniors don't normally get. But I truly just got the lesson that you need to start before you're ready. At least when it comes to money, financial decisions, like anything where the outcome is not guaranteed, but the upside is potentially big, I think that's the case. And I really learned this. You're never going to have all the information and you're never gonna know the outcome in advance. And you're never gonna not feel scared either. The real learning only starts once you have some skin in the game. So people message me all the time with questions like, should I invest in this or that? Or what if this or that happens? Or should I wait until the next crash, etc.? Should I get in now or later? And I always respond with some variation of just get started. Because there's only so much you can learn by studying and getting ready to get ready. Getting started with a small amount, whatever you can handle now, I really think that is the best way to jump in. So that's my long-winded way of explaining the first investing rule to live by, which is to start before you're ready. And now for rule number 2, which is to take yourself out of the equation as much as possible. As much as we like to think that we are logical and rational beings with our money, 90% of finance is actually behavioral. So here's a really eye-opening statistic. According to Dalbar, a reputable market research firm, the S&P 500 index averaged 9.85% for the 20 years ended 2015. However, the average stock fund investor earned only 5.19%. Isn't that super interesting? All you had to do was stick your money in an S&P 500 index fund to make an almost 10% annual return, yet the average person did a lot worse than that. Why? Because they made emotional buying and selling decisions. They probably put more money in when the market was going up and then took money out when the market was going down, which, is the opposite of what we should be doing. And in reality, they actually would have been much better off just doing nothing at all, just buying and holding. So this is very natural. It's only human to want to act on your fear and on your emotions, but human behavior is actually counterproductive, at least when it comes to investing. That is why it's good to take yourself out of the equation as much as possible by automating. That way, you're 1 degree removed from the decision making, less likely to do something you'll regret later on. For example, every month, I have money automatically going from my checking account to my retirement account to buy more index funds and investments every month. I hardly ever look at it, and honestly, I usually totally forget that it's happening. But that's good, because if it were up to me to make investments manually every month, I would definitely find excuses not to. Some month I would say I don't have enough money this month, or another month I'd say the market's too high, it's not a good time. Another time I'm afraid, I'm too tired, blah, blah, blah. Another way to take yourself out of the equation is by creating a decision-making system that future-proofs you from your own emotions. In other words, you write it down somewhere, like a plan. When X happens, I will do Y. For example, you could do this with stocks that you want to buy. Back in 2018, towards the end of that year, you might recall the market had a mini crash of almost 20%. And up till that point, I had been really wanting to buy some stock in Apple, but I thought it was too high. So I had this target buy price in mind of $40, so I made the decision in advance. When Apple goes to $40, I will buy 100 shares. And just as a side note, this is before the 4-for-1 stock split, so it was actually a target buy price of 160. Right around the time that stock was falling and approaching my target price, I got really scared. My alarm bells, my reptile brain started going off like crazy, and I almost did not pull the trigger. But I did it anyway because I had written it down and made a plan in advance. If X, then Y. So even though I didn't get in at the exact bottom, and Apple actually fell a lot more after that, the stock went back up shortly after, like way up. So I'm really glad that I created a plan in advance and just followed it. If I'd left it up to my reptile brain, my emotional brain, to make the decision for me at that time, I definitely wouldn't have bought. So the key here is that I took myself out of the equation by making the decision ahead of time during a time when I could think rationally. When X happens, I will do Y. So then that made it more likely that I would do the logical thing, which is to buy a bunch of stocks of a great company when it goes on sale. So despite having a really, pretty good understanding of the subject, I find that half the battle to being a good investor is just fighting my basest human emotions, fear and greed. It's really just part of being human. So I found that the only way to get around that is by putting a system in place and just following the system. So here are 2 specific ways you can do this in your own finances right now. You can log into your job's HR portal and just increase the percentage contribution from your paycheck to your 401k. That's if you have a 401k. So every time payroll happens, your 401k assets are going to get bigger and bigger without you lifting a finger, and you will barely even notice. Another thing you can do is set up a recurring investment from your checking account into your IRA to buy more index funds. This is good because it enables you to take advantage of a strategy called dollar cost averaging, or making recurring purchases on a consistent basis. Rather than dealing with questions every month like, should I buy now? Is it a good time to buy? Should I buy later? If I buy now, how much should I buy? That's a lot of decision fatigue. So dollar cost averaging eliminates all of that, it takes you out of the equation, and ensures that you put your money to work. If you want to learn more about dollar cost averaging, I also talk about that in more detail in this video right here. Moving right along to rule number 3, expect volatility and use it to your advantage. Investing your money, as opposed to keeping it in a bank account, means dealing with a lot of ups and downs, or to use technical terms, volatility. Most people use volatility to their detriment. When the market's going up, they don't want to miss out, so they buy. When the market's going down, they don't want to lose money, so they sell. The result, you end up buying high and selling low. Repeat until broke. This is how most people, if uninformed, get burned. I've been guilty of this myself too. But volatility is actually, it's expected. It's part of the game. In fact, the stock market experiences a crash about every 5 years. So it actually happens pretty frequently. So if you're going in, you should expect the roller coaster ride. It's kind of like if you go to Six Flags and you get on one of the roller coasters, you're not going to jump off in the middle because it's scary, right? You knew what you were getting into when you came to Six Flags. Otherwise, you would have just stayed home. Just like in the story I shared about Apple, even though it is scary when stocks go way, way down, it's not like they go down because they've become permanently less valuable. Often stocks go down because people are short-sighted and, become very pessimistic, overly pessimistic about the future. And pessimism really does tend to get very exaggerated in the stock market. So I'm not saying it's easy by any means, but as a smart investor, you want to greet downturns as a chance to buy great investments on sale. So that's rule number 3. Train yourself to get used to market volatility. Don't be scared of it, or try not to be, and use it to your advantage. And now for rule number 4. Always be learning, thinking, and reading about the world around you. What I love about investing is that it forces you to stay on top of what's going on in the world. Potentially everything in the news is something that could affect your investments. Political developments, scientific discoveries, big global trends like demographic changes, disruptive technologies, etc., etc., etc. All of these are clues as to what might happen next in the financial markets. A really great way to stay on top of the news, news that actually matters, is to subscribe to a daily news roundup, such as the Economist Espresso. This is a daily email that summarizes all the main headlines of that morning. Super helpful. I really love it. I read it every morning along with my bulletproof coffee. For example, on April 1st, the Economist Espresso announced about President Biden's $2 trillion infrastructure bill. So later that morning, when the S&P 500 broke 4,000, which is a very high level, I was not that surprised. So reading the news gives me a general idea as to why my investments are doing what they're doing, and it feels good to feel informed. Now, you do have to be a paid subscriber to The Economist to get it, but I find that it's one of the few subscriptions that I really can't live without. They also have an app where you can listen to their articles, and it's really good for to listen to during walks with my dog, or maybe during your morning commute, or washing dishes. Seems like I'm always washing dishes. Another news roundup email that I really love, and this is free, is the Skimm. It's geared towards women, and they do a really good job of explaining important news headlines in a fun, relatable way. Hey, before I get into rule number 5, I wanted to quickly interrupt this video to invite you to my upcoming stock workshop, How to Build a Winning Watch List. In this live 2.5-hour workshop, I'll be walking you through my step-by-step stock research process to help you pick out some stocks to put on your watch list. If you've ever wondered how to know if a stock is a good buy or not, you'll definitely want to come to this workshop. It'll be really fun. I'll be doing it live on Zoom. You'll be able to ask me questions at the end during the live Q&A. So I think it'll be fun. Join me this Saturday. I'm only doing it this once. So make sure to go to rosehan.com/stockworkshop to sign up and get all the details. Now let's get into rule number 5, which is to know what kind of investor you want to be. Now there are 2 types of investors: passive investors and active investors. Passive investors invest their money into the overall economy via a stock market index fund. Since index funds contain hundreds and sometimes even thousands of different stocks, investing in them is like owning a little piece of the entire economy. It's a very simple and passive way to invest and to benefit from the long-term uptrend of the economy while generating an average return of 7 to 10%. On the other hand, active investors take the time and energy to research investments that will outperform the overall stock market. They tend to have a lot of expertise and put a lot of time into managing their investments in exchange for a higher return. Since active investing takes effort, passive investing tends to be the better fit for the vast majority of people because they're busy and really not that interested in doing this stuff. So you only really have two choices. The first choice is to make a serious commitment in time and energy and learning to become a good active investor, or just go the passive route, stick your money into index funds and call it a day. You can also do a mix of both, which is what I like to do. You can invest the majority of your money into index funds and also do some active individual stock investing here and there just to bump up your returns. The only thing is, if you want to be an active investor, make sure you know the difference between being an active investor versus a speculator. An investor looks at a stock as part of a business and carefully evaluates the intrinsic value of the business that she's buying into. On the other hand, the speculator is playing with pieces of paper. Investors look at company financials, whereas speculators look at price charts, technical indicators, momentum. So day traders are speculators. The kind of people who bought into GameStop, they are speculators. So just because you buy stocks doesn't mean you're an investor. There's a difference between investing and speculating. So if someone is talking all about stock charts, moving averages, support and resistance, Fibonacci levels, candlesticks, getting in and out quickly, opening and closing a position, they're talking to speculators and day traders. Now, if they're all about earnings growth, economic moats, return on capital, free cash flow, they are talking to investors. So investing and speculating are two very different skill sets, and it'll be very helpful for you to understand which one you're doing and what it takes to be good at it. So taking the time to think through whether you want to be a passive or active investor, and if you want to be an active investor, whether you want to be an investor or a speculator, all this will really help you get clear on what it takes to succeed, what you need to know for that style of investing, and as a result, help you filter out any information that isn't relevant to you. And finally, rule number 6, exploit your biggest edge as an investor, a long time horizon. And don't take my word for it. As said by legendary value investor Seth Klarman, the single greatest edge an investor can have is a long-term orientation. In today's world of smartphones, 24/7 connectivity, and massive short-term data overload, most players in the market are concerned with minute-to-minute performance, day-to-day performance. Over the last few decades, investors' timeframes have really shrunk thanks to technology. Wall Street, hedge funds, mutual funds, they're mostly obsessed with quarterly returns and at the most annual returns. So managers will get fired for not delivering positive results, a few quarters in a row. So almost everyone is operating on short time horizons, very impatient. But as an average everyday investor without the quant tools and trading algorithms that the big players have, I wouldn't even try to play the short-term game. So one way to gain an advantage is by ignoring all this noise and just buying and holding. In fact, all the greatest investors of our time have a longer time horizon than the rest of Wall Street. Think Warren Buffett, Charlie Munger, David Swensen, Joel Greenblatt, Manish Pabrai, etc., etc., etc. It's not really sexy to invest this way, but it really does work. Rather than thinking in terms of 5 days or 5 months, where emotions and short-sighted thinking is mostly what's dominating, your best shot as an average investor is to plan to hold for a longer period than anyone else. I always love a really good David Swensen quote. Now, he's the portfolio manager of Yale's endowment fund, for those of you that don't know him. To paraphrase what he said, if you can invest with a 3 to 5 year horizon, ultimately, that, I think, is an incredibly powerful advantage. And the people that are on the quarter-to-quarter time frame, they're going to lose almost certainly. That's why people who just buy and hold over the long term become everyday millionaires without, being like stock market geniuses. Whereas the impatient people that chase after this hot stock or that hot stock, many of them end up making it big and then losing it all soon after, just really sexy stories of big gains and big losses. So in conclusion, if you don't know what your edge is, you don't have an edge. But if you invest with a long-term orientation, you have an edge. So that's it for what I think are the 6 investing rules to live by. Start before you're ready, because the reality is you're never really gonna feel ready and you're never gonna make perfect decisions. So instead of trying to be perfect, just get invested. 2, take yourself out of the equation as much as possible. Automate your finances, and build a system that makes decisions for you so that financial freedom becomes a natural, inevitable result of that system. 3, expect volatility and use it to your advantage. Train your mind to see fluctuations in the market as an opportunity and as, just normal par for the course rather than as something to run away from. 4, always be learning, thinking, and reading about the world around you. Understanding what's happening to your investments means understanding what's going on in the world. We live in a very interconnected, globalized world. So rumor has it that Warren Buffett reads 6 newspapers a day. You don't have to go that far, but definitely try to sign up for some sort of daily news roundups. I love those. And, get them in your email, like the Economist Espresso. 5, know what kind of investor you want to be. Know the difference between active versus passive investing and investing versus speculating. That way you can learn what it takes to succeed in that area and not get distracted by strategies and information that aren't relevant to you. 6, exploit your biggest edge as an investor, a long time horizon. Be different, be contrarian. Just because everyone else is fixated on short-term returns, thinking longer term will give you an edge, so use it. As you can see, it all comes down to behavioral stuff. Thinking long-term, knowing the facts, having the courage to take action, and not letting your emotions get in the way. I really love studying great investors, reading about them and trying to extract the essence of their approach to investing and to life. And seriously, no matter whose book or investor letter I read, they all seem to come back to some variation of these 6 rules, time and time again. Hope you enjoyed this video. As always, thank you so much for watching. Now, if you've been around my channel for a while now, especially if you've been here since the beginning, thank you, I love you. So it's been about 2 years, and pretty much what people know me for, what you probably know me for, is explaining money and investing stuff in a way that's not boring and pretty easy to understand. And I actually really love that. I love talking about money, explaining things that are sort of like abstract and confusing and making them accessible to people like you and me. But I'm actually feeling called to start pivoting in a different direction. I think I have a really big archives on my channel of how-to videos, like factual strategies, explainer type videos. And I'll probably be doing more of those, for sure. But I'm thinking of introducing a different type of, format, different side of me to this channel. I'll be making some really big changes in my life coming up. For those of you who are part of my email newsletter, you know that I just got out of a relationship, a divorce, and I'll be moving soon. I'm not going to tell you exactly where yet, but it's going to be really cool. So I'm just making a lot of changes, reflecting a lot on my life, and this channel is an expression of me, right? It's about what I'm passionate at the time. And for the last 2 years that I've had this channel, it's been, I guess what I was really passionate about is explaining all the stuff that I was learning about investing and like feeling so empowered and wanting to share it with you. But I think what you're ready for and what I'm ready for is a little more like realness, some more storytelling, maybe a little more like vlog style of like what I'm going through, what my budget looks like that month, like what I'll be doing with my money that month, what I spent it on, what I'm looking at investing in, like how much dividend income I'm receiving, like that kind of stuff. So just more like a financial journal, using my channel as more of like a follow my journey type thing. So anyway, just know that that's coming. I'm just, simmering. There's ideas simmering. So yeah, if you've been around, I really hope you'll stick around for that. I've got some really cool things planned. And if you're new around here, I hope you will subscribe. And yeah, I post new videos every week, every Wednesday. So I will see you next week, same time, same place. Bye for now.